I'm Mira.
Before we jump in, we need to briefly and clearly state that this deep dive is for market context and fundamental discussion only.
Right, exactly. It is not personal investment advice or, a recommendation to buy or sell securities.
It's definitely not. So if you're wondering how to make sense of your portfolio today, you're in the right place. Our mission today is to unpack this crazy current tug of war in the markets.
It really is a tug of war right now.
Yeah, we're looking at the U.S. equity and global market action for Monday, April 6th, 2026. And we've got these escalating Middle East geopolitical risks. We've got sticky structural inflation. And then on the flip side, this massive $690 billion AI capital expenditure supercycle.
Which is basically the only thing keeping equities afloat right now.
Exactly. So let's just get right into it. What set the stage before the U.S. session?
Well, to understand today, you have to remember that U.S. markets opened on Monday, April 6th, needing to digest just a massive backlog of events.
Right, because we had the prior session and then the holiday weekend on top of it.
Exactly. The weekend overhang was huge.
Yeah, and speaking of that prior session, we have to talk about the Good Friday U.S. jobs report from April 3. It came in at a surprisingly hot 178,000 jobs added, and unemployment was sitting at 4.3%.
Right, which looks really strong on the surface.
It does, but I have to ask, is this just a mirage? Is that headline number hiding the fact that the data was heavily inflated?
Oh, absolutely. It's heavily inflated.
Yeah, because we had the return of those striking healthcare workers, right? 31,000 of them, plus those weather reversals.
Yeah, that's exactly it. And if you dig just a bit deeper, you see downward revisions to the February data, too.
Okay, so the underlying trend is actually much softer.
Right, definitely. So that was the economic backdrop, but then you had the severe geopolitical carryover from the weekend hitting at the same time.
Man, the weekend was intense. We had President Trump's 48-hour ultimatum to Iran to reopen the Strait of Hormuz.
Yes, and that came with very specific threats to strike Iranian power plants and bridges.
Which is a huge escalation risk for the region. Plus, we also saw the implementation of the expanded Section 232 tariffs on metals.
Right, which is just adding fuel to the inflation fire.
Yeah, it really is. And on top of all that, over the weekend, we had this successful rescue of a downed U.S. F-15E crew member.
Which was significant because it removed a potential hostage variable, but the market was still incredibly tense.
For sure. And that anxiety really spilled over into the early Monday morning data, like pre-U.S. trading.
Yeah, if you step chronologically through early Monday, April 6th, it paints a pretty grim picture. At 10:30 a.m. India Standard Time, which is 1 a.m. Eastern Time, India's March Services PMI showed a slowdown to 57.5.
So we're already seeing an early global macro drag.
Exactly. The energy costs are hitting them. Then, at 11:30 a.m. Iran Standard Time, so 4 a.m. Eastern Time, Israel struck Iran's South Pars petrochemical complex.
Wow. Right at the heart of their energy infrastructure.
Right. And then, to just completely close the door on any pre-market optimism, by 6 a.m. Eastern Time, Iran officially rejected a 45-day ceasefire proposal.
Man, so you have this intense combination of geopolitical escalation, tariff implementations, and it just created a highly anxious backdrop for the opening bell.
It really did. The market was on edge.
Well, we're going to take a quick break here. When we come back, we'll see exactly how the U.S. cash session violently reacted to a fresh wave of inflation fears.
We'll be right back.
Okay, we're back.
So what moved markets during U.S. trading hours?
Well, it was all about the inflation catalyst today. Right at 10 a.m. Eastern Time, the U.S. ISM Services PMI was released.
Right, and the main PMI was 54.0, which, isn't terrible.
No, but the internals were a disaster. The prices index violently jumped 7.7 points to 70.7.
Wow.
Yeah, that is the largest one-month increase in over 13 years.
Which is just wild to think about. And fundamentally, that specific data point acted as a transmission mechanism for stagflation fears.
Because it shows input costs surging while growth might be slowing.
Exactly. When you combine that with the energy supply shock from the Hormuz blockade, it forced the 10-year U.S. Treasury yield all the way up to 4.34%.
4.34%. That is a massive move for the 10-year.
It really is. And the banks reacted instantly. At 11 a.m. Eastern Time, Wells Fargo officially scrapped its 2026 Fed rate cut expectations.
Just completely took them off the table.
Completely, confirming this new higher-for-longer reality we are stuck in.
Okay, but wait. Let me just pause and ask a question here, because the math is not mathing for me.
Okay, what's up?
So, bond yields are spiking. Rate cuts are officially dead according to major banks, and we have an active escalating conflict in the Middle East.
All true.
Yet the S&P 500 closed the day up 0.44%. How does that math work?
Yeah, I know it sounds completely backward, but it all comes down to equity risk premium compression, or ERP.
Okay, break that down for me.
So, over the weekend, the market was pricing in the absolute worst-case scenario. Total uncertainty, right? Investors demand a huge risk premium just to hold stocks when they don't know what's going to happen.
Right, the fear of the unknown.
Exactly. But then, at 3 p.m. Eastern Time today, President Trump held a press conference.
Oh, where he detailed the rescue of the pilot.
Yes, but the key part for the market was that he confirmed a clear Tuesday, 8 p.m. Eastern Time deadline.
Ah, so it gave investors a definitive timeline.
Yes. That binary clarity actually caused the VIX to cool down. And when the fear gauge cools, it compresses the risk premium, which automatically re-rates equities upward.
So just knowing exactly when the bad news might hit was enough to make people feel safe to buy.
Essentially, yes. Plus, you have to remember that the market's floor right now is relying on brute force earnings expansion rather than just multiple expansion.
Companies are actually generating massive cash flows right now.
Exactly. They are hiding in fundamentally strong companies.
Well, the closing numbers definitely reflect that. Like we said, the S&P 500 up 0.44%, the Nasdaq was up 0.54%, and over in commodities, WTI crude settled at $112.41, while gold traded up in the mid-4,600s.
Right, still holding those safe haven premiums.
Yeah. So to summarize all of that, macroeconomic clarity, even when it's grim, actually allowed investors to buy the dip.
It's all about removing the uncertainty.
Exactly. We're going to take one more short break, and coming up, we'll dive into Session 3 to reveal exactly which companies those dip buyers were targeting today.
Stay with us.
Welcome back. So for our corporate events recap and what to watch next, how did individual companies weather today's storm?
Well, if you follow the money, capital is flowing very heavily into tech and defensive industrials right now.
Right. People want safety.
Yes, but they also want to capture the cash flows tied to that massive $690 billion AI capital expenditure supercycle we mentioned at the top of the show.
Oh, that AI infrastructure sprint. Yeah, it's just a juggernaut.
It really is, and we saw that clearly in the single name movers from this morning. For example, at 7 a.m. Eastern Time, Goldman Sachs upgraded Netflix to a buy with a $120 target.
Nice. And they closed up 0.27% on a day like today.
Yeah, showing real resilience. Then at 8 a.m. Eastern Time, Bank of America reiterated a buy on Apple based on the new MacBook Neo cycle.
More tech safety. But, there was also a really fascinating carryover narrative being digested today regarding Amazon.
Oh, the logistics surcharge.
Yeah. So back on April 2, Amazon announced a 3.5% fuel and logistics surcharge. Now, normally that might look like margin distress, due to inflation.
Right, like their costs are getting out of hand.
Exactly. But the market is actually viewing it as proof of extreme corporate pricing power in an inflationary environment.
Meaning they can just pass those costs along without losing customers.
Exactly. But it definitely wasn't all good news for the mega caps today.
No, it wasn't. Because at 9 a.m. Eastern Time, JP Morgan reiterated an underweight rating on Tesla.
Right, and that was a harsh warning. They cited a potential 60% drop to a $145 target.
Yeah, due to serious delivery and cash flow concerns.
So between Amazon's new fuel surcharge and Wells Fargo scrapping 2026 rate cuts entirely, it seems like the only thing getting cheaper these days is Tesla's stock price.
Yeah, it certainly feels that way right now. The market has no patience for cash flow issues.
No, it really doesn't. But thankfully, the broader market still finished in the green today, proving that dip-buying investors are much harder to kill off than a Middle East ceasefire proposal.
Huh, they really are incredibly stubborn.
They are. Plus, thanks to Goldman's upgrade on Netflix, we can all at least afford to binge watch a good distraction while waiting for tomorrow's looming geopolitical deadline.
We might actually need that distraction, to be honest.
Yeah. Speaking of which, let's talk about what to watch next. We have a very strict next 24-hour horizon for April 7.
Right. And the absolute focal point for tomorrow is the expiration of President Trump's Tuesday, 8 p.m. Eastern Time deadline regarding the Strait of Hormuz.
So that's the big binary event the market is waiting for.
It is the only thing that matters right now. You need to watch for the probability of immediate U.S. strikes if no de-escalatory signal emerges before that deadline.
Okay, so military action is on the table. What else?
You also need to monitor regional ceasefire headline flows. Any tiny update could swing the markets. And keep a very close eye on updates regarding oil shipping insurance.
Oh, right, because if insurance rates spike, it means the physical threat to the tankers is rising.
Exactly. It's a real-time fear gauge.
So geopolitics are front and center. But what about the economic data? Are we getting any more inflation shocks tomorrow?
Actually, investors can breathe a tiny sigh of relief on the data front. The major U.S. inflation releases, like the CPI, they don't hit until April 9 and 10.
Okay, good to know. So the immediate focus is purely on geopolitics.
Yes, 100%. But, before we wrap up, I want to leave you with a broader concept to ponder.
Oh, I like these. Let's hear it.
What if this unprecedented $690 billion AI capital expenditure sprint isn't just about technology anymore?
Okay, what do you think it is then?
What if it is effectively becoming the market's ultimate macroeconomic hedge?
A macro hedge. How so?
Well, think about it. In a world where physical supply chains are threatened by war, right? And fiat currency is constantly pressured by this sticky structural inflation.
Yeah, which we're seeing clearly today.
Exactly. So owning the physical infrastructure of the future, the data centers, the power generation, the hardware that might actually be the only reliable safe haven left.
Wow. That is a fascinating shift in perspective, hiding from inflation and war in physical AI assets. Well, thank you so much for joining us on this deep dive. Let us know in the comments how you're hedging against this week's geopolitical deadlines.